Hey buyers, getting frustrated with those high interest rates out there? If you want to know how to navigate around them, watch this video. Everybody, Christina Ingram here with the Ingram Group of Keller Williams Realty Las Vegas. I'm here with Dustin DeHart of Keller Mortgage, and I'm sure you all heard of the rising interest rates in the market, and some buyers are freaking out because they're not able to qualify for what they used to qualify for. And we're here to talk about some of the things that we can do to help keep you in the market looking for a home and keeping your payments affordable. So I wanted to introduce Dustin and talk about some of the programs that he's got available that we can help you with so you don't have to give up your dream of home ownership.
Well, yeah, so rates have gone up, right?
Obviously.
Literally 4 points.
Yes.
Since, the beginning of the year.
Yes.
Since August, we've gone up almost 2.5 points, which is the fastest ever in the history of mortgage rates. So, yes, it's certainly giving some people cause for pause, right? And I get it.
Completely understand, yes.
Yeah, but the good thing is the market is giving us something,
yes.
right? And what that is seller concessions,
correct.
Right? As well as now you don't have to overbid on properties. You can take your time. You don't have to waive appraisal contingency, stuff like that. So we all get that. But what we're seeing nowadays, Christina, and it's just crazy. Like, we look at a purchase contract now, and if we don't have seller concessions on there, we're like, what's going on, right? Like, literally, just a few months ago, you would never see seller concessions.
And if you did, you were like, oh my God, this is like, you must have been Jesus selling this.
The seller's like, you're going to pay for my closing costs, right? So look, there's a lot of different ways that we can use that money. Right. Okay. So ultimately, we got to figure out what is the goals for the buyer. Right. Okay. Now, right now, the main concern for buyers is their payment. Right.
Correct.
With rates going up that much, the payments have gotten egregious. So let's face it. Right. So there's a permanent buy down, which we all know. Like, there's a rate, and then you want a lower rate. Well, there's a cost to it. Right. So let's just take 7% for. Just for an interest rate, to put that out there right now. And that's about where they're at right now. Okay. So if for a permanent buy down, let's say we got enough money to buy the rate down 0.5 point, right? That's not moving the needle so much for buyers, right? So what we're seeing is...
Especially if it's been at 4.
Yeah, exactly. And it's just, the payment's going down a little bit, but it's just not that much, right? 6.5 sounds better than 7. But certainly not something that's going to really push them to go, okay, I need to do this now, right? So what we're seeing in lieu of that is what's called a temporary buy down, right? So that was the permanent buy down, right? That's now your rate for perpetuity. Unless you refinance it, then now you have 6.5. So on the 2-1 buy down, what we're doing is using seller paid funds to give you, instead of 7%, year 1, you get 5%, right? Now, depending on the loan amount, obviously, it will dictate how much reduced in payments that would be. But, for a $400,000 loan amount, that could be a $500-600 a month in payment. That's a big amount, yes. Right? And in year 2, it would adjust to 6%, right? Now you're saving $200 or $300 a month still, right? And then by year 3, it would go to the locked rate of 7%. Now, it's not an adjustable rate mortgage. It's locked at 7%. We're just using those funds from the seller to pay the delta of that payment reduction until we get to year 7. Now, what we also are, showing people is like, look, the goal, right? Now, everybody loves that phrase, marry the home, date the rate, but we have to be careful with that, right? Because we don't know for sure.
We don't know for sure when the rates will go down.
Right. Or even if you can qualify
for it. Or if they'll go down significantly.
Exactly. Now, the good news is just yesterday, the Mortgage Bankers Association and Fannie Mae are predicting that we should see rates in the 5s, low 5s, second quarter of next year.
Oh, nice.
And it's somebody that's I have used for rate advice my whole career, who's one of the best in the business, this guy Barry Habib. he's even more bullish, and he thinks maybe early next year, right?
Okay.
Now, again, things change, right? So the goal would be, hey, we get you into this 5% rate, and then next year rates are down 5%, and now you can refinance. Well, you've never experienced these high rates, right? And we always often understand as well, these when rates go to 5, that's kind of where they should have been in the first place, right?
They were projecting that back in 2019, and they just kept them falsely low for 2 years, which helped lead to the hyperinflation that we're experiencing now.
100%. Yeah, I mean, we both saw the real shift, right? We got through that, and the Federal Reserve had to come in and spend a ton of money to keep rates artificially low. And you're right, about 2019, they were starting to pull back on that, and rates were headed in this direction, maybe not 7%, but then COVID hit, right? Then they went to 7%, and then they doubled down, and now rates are under 3%.
Correct.
So.
And people got addicted to the low rate, because it was basically free money.
It was, and it was a gift of God for loan officers to refinance their whole database. And,
well, yeah.
Yeah, it's
and everyone, if you didn't take advantage of that, well, unfortunately, it's unfortunate.
It is, but it's still, our parents had double-digit rates, right?
Oh yeah. My parents, I think, when rates, I remember back in the early 2000s, my dad was like, "Oh, I think I'm refinancing because the rates are going down to 7." So I was like, "Well, what are you at?" Like, it was close to 10, so yeah.
Yeah, I got into the business right when the shift was happening in 2006-7.
Same.
And rates started to come down, and then boom, everything changed, and then all of a sudden rates were at 3%. So
I think that's why with this market shift, I'm not like, market shifts don't feel good.
Right.
They don't feel good for realtors. They don't feel good for loan officers, and I'm sure it doesn't feel good for the public. But it's not like what happened in 2007 to about 2009. Like that was a complete
bankrupted our country.
Yeah.
And they blame it on us.
Yeah.
But yeah, this is certainly different. But we saw 2 years of just unprecedented, appreciation in home values and low rates. Now the law of averages are coming down, right? And we're getting back to where we should be.
I mean, homes were almost doubling in like 18 months.
Yeah, and
that's unheard of.
And as a buyer's agent back then, it was how frustrating was it for buyers?
Yeah, it was like, do you have cash?
Yeah, exactly. So we're using the buy downs. You can also use the money for closing costs if you're, just want to, pocket more money.
Now, the question now, if someone wanted to just buy down their rate permanently, what is the difference in that cost versus like a 2-1 buy down that we were just talking about?
So great question. So it just depends on how much they want to buy it down, right? So with the 2-1 buy down.
Let's just go with a point. Let's say from 7 to 6.
Sure, that's going to probably take a good 3% of the loan amount, maybe even more.
So
to
the
get
full,
it down a point.
the full concession.
Yeah, and I'm probably being a little conservative there, so it's probably a little more than that. So typically for the 2-1 buy down, and it has to come from the seller. That's it. Can't come from anybody else. It's about 2.25%, 2.5% of whatever the loan amount is, right? So if it's a $400,000 loan, we need about 10 grand from the seller. Is basically what it comes down to. And we're seeing $10,000 concessions all the time, right? Like that's not crazy.
If you're on a $400,000 house, you're probably getting $12,000 in concessions.
Exactly.
So real quick though, now I was talking to other lenders, and on the 2-1 buy downs with like a VA loan, does that matter how that money is distributed? Because they had mentioned, I'm very restricted with VA on what I can contribute. So does the type of loan play into factor with that too?
Great question. So typically it's for conventional loans.
Okay.
What
about FHA?
For FHA and a VA, it's investor based.
Okay.
So some lenders may be able to do it for FHA and VA, some don't. We're in the process of getting approved to do it FHA, so we should have that any day now. VA, I'm still being told that they're working on that. So yeah, there is some more. There are a little more hurdles to jump through.
You would think that they would like all those concessions for our veterans.
I know. It's just it's those damn investors.
It's to me, it's the best loan out there. The VA
it certainly is.
Those people earned the lower rates. They've earned not having mortgage insurance, and I think if people want to give them money so they can buy down the rate even further, shouldn't be an issue.
Absolutely. And, veterans can also, VA IRRRLs, which are basically streamlined. So
What is an IRRRL?
it's an interest rate reduction loan, so it's a refinance, right? So no appraisals needed, no income. When rates drop, it's simply fill out an application and we drop your rate. So, so even if property values were, because they're usually putting no money down, right?
Mm-hmm.
God forbid they were a little upside down, they would still be able to refinance once rates go down. And they will.
You see, do you have that, veterans?
Yeah.
You have that option
Yeah.
too, so keep that in mind.
And rates
And
will
keep
go
them in
down.
mind.
Inflation, when that goes down, rates will go down. So
Yeah.
that's the big key. But, we're also, I've just saved a deal the other day using money to pay off debts for a buyer. Right?
Okay.
So it actually got them approved.
Can
right?
seller concessions do that as well?
They can.
Okay.
In fact, I saved a deal the other day doing the same thing where we paid off a loan for like $8,000 that had a $400 payment, and that was enough to make them comfortable.
Real quick though, now I was talking to other lenders, and on the 2-1 buy downs with like a VA loan, does that matter how that money is distributed? Because they had mentioned, I'm very restricted with VA on what I can contribute. So does the type of loan play into factor with that too?
Great question. So typically it's for conventional loans.
Okay.
What
about FHA?
For FHA and a VA, it's investor based.
Okay.
So some lenders may be able to do it for FHA and VA, some don't. We're in the process of getting approved to do it FHA, so we should have that any day now. VA, I'm still being told that they're working on that. So yeah, there is some more. There are a little more hurdles to jump through.
You would think
with
that
VA,
they would
right?
like all those concessions for our veterans.
I know. It's just it's those damn investors.
It's to me, it's the best loan out there, the VA.
It certainly is.
Those people earned the lower rates. They've earned not having mortgage insurance, and I think if people want to give them money so they can buy down the rate even further, shouldn't be an issue.
Absolutely. And, veterans can also, VA IRRRLs, which are basically streamlined. So
what is an IRRRL?
It's an interest rate reduction loan, so it's a refinance, right? So no appraisals needed, no income. When rates drop, it's simply fill out an application and we drop your rate. So, so even if property values were, because they're usually putting no money down, right? God forbid they were a little upside down, they would still be able to refinance once rates go down. And they will.
You see, do you have that, veterans?
Yeah.
You have that option too, so keep that in mind.
And rates
And
will
keep
go
them in
down.
mind.
Inflation, when that goes down, rates will go down. So that's the big key. But, we're also, I've just saved a deal the other day using money to pay off debts for a buyer. Right?
Okay.
So it actually got them approved.
Can
right?
seller concessions do that as well?
They can.
Okay.
In fact, I saved a deal the other day doing the same thing where we paid off a loan for like $8,000 that had a $400 payment, and that was enough to make them comfortable buying a house right now. So, we can get rid of them mortgage insurance, right? We all know if you don't put 20% down, you don't have to pay it monthly. There's a single premium option where we could just pay it off and you don't have mortgage insurance, even if you're paying less than 20. So there's a lot of different ways to use these concessions, but we have to figure out what the goals are for the buyer and working with a great team like you have, meeting those goals and, and really helping them meet their objectives.
All right. Quick question too. So other lenders, and I know I've called and asked you, but I just want to make sure we share this with everyone. Your thoughts on a 40-year mortgage, because some people were saying, hey, do a 40-year mortgage.
Yeah.
That way it's amortized over 40 years and your payment will be lower. So what are your thoughts on that?
Well, my thoughts are 40-year mortgages are non-qualified mortgages. So if you want a normal mortgage, i.e. conventional, Fannie Mae, Freddie Mac, FHA, and VA, they don't allow 40-year mortgages. And I don't think they're coming down the pipeline anytime soon. That would take literally legislation from Congress of the huge bill that got passed when we
when you're saying they're not a qualified mortgage, meaning the government won't buy those.
Correct. Well, yeah,
those
the GSEs aren't going to sponsor, and they can't. So there's legislation that makes a mortgage either qualified or non-qualified. Right now there are other investors that don't sell their loans to Fannie and Freddie, right? And you typically know these as bank statement loans, stuff like that, right? So
they're higher risk.
Absolutely. Higher rate, right? So you're going to get a higher rate anyways, but now you stretch it over 40 years, it's probably the same as a 30, right? It's a lot of widgets and, people just sending stuff just to get that wow factor that hopefully Christina calls them, even though they're probably never going to put anybody in that 40-year mortgage. But for jumbo loans, if it's over the conforming loan limit, there are a little more options for it. But, for 99% of the people out there, 40-year loans are not something.
Not a good idea.
Yeah, or really are going to be able to look at that.
All right, got it. Because it came up and I was like, why would anyone want to do that? Like now
we're getting back to where this all started.
I know.
Right?
Now we're getting overly creative, and not as regulated. Which
we're still heavily.
There needs to be a healthy balance between
100%. We were a little too overregulated before. Now we've kind of, eased up on some things, but we certainly can't get back to where we were in the good old days where everybody got along. Right?
Basically, if you had a pulse.
Yeah, but look, buyers.
You didn't even have to have a pulse.
You
could be a dog, and you could get a loan.
That's right. But yeah, look, at the end of the day, we know the market's not as bad as people think, right? So you're going to buy a house, like, understand there's, the best time to buy a real estate was always 5 years ago, right?
Or 20.
Right, exactly, right? So, the house is going to appreciate, right?
Mm-hmm.
We went way up, we're supposed to be at 4%. That's kind of the law of averages. We're just getting back to normal. If you're going to be in a house for more than 5 years, you're going to make money on that house, right? I mean, especially in this city with all the, the economy doing as well as it is, and the building and the sports franchises and everything else. Like, literally, it would have to be some disaster for you not to.
And at that point, we're all screwed in.
Yeah, exactly. Then what's the point?
Yeah. So, I mean, if it's the apocalypse, it's the apocalypse.
Yeah.
And we all are going to be on the streets fighting each other for whatever, and money would have no value at that point anyways. And I like that you brought it up, that if you're going to be purchasing now and you're purchasing long term, then you're going to be sitting pretty, because I get asked all the time, like, is it now is a good time to buy? Well, it goes back to that depends on your situation. If you are looking to buy it now and then sell it in 9 months because of what happened the last 2 years, I'm going to advise you not to do that. But if you're thinking, hey, I'm going to be in this house for 5 years or even 3 years, and then I'm going to rent out the house, as long as that all pencils out, which rents are still penciling out for mortgages, and rents are staying pretty stable, and they're a lot higher than they were a year and a half ago. So if you're planning on doing that and holding the home long term, you're always going to win, because real estate is a long term investment and not something that is short term. If you're a flipper, you should know how to do the buy anyways, because you're going to be looking at least 30% back of value, even to try and flip. If you're buying it at market value because you have an inexperienced realtor who hasn't been through one of these shifts, then you're going to get really hurt and you're going to lose a lot of money.
Absolutely. Yeah, and again, when we speak to buyers, we ask them their long-term goals, right? Now, when we have somebody that's wanting to buy an investment property, is now the perfect time? I don't know.
As long as it pencils out. Depends on how much you're putting down.
You can do the cap rates and figure it out, then we give you the information so you make the right decision.
Correct. I mean, because, cap rates for a while, especially in certain neighborhoods, were only like at 4 and 5%. And
what's the 6 to 10? Is that what we're usually on for?
Well, it depends. Yeah. And that goes back to what's their goal.
Sure.
Like if their goal is just cash flow, then it might be, because over the long period of time, you might start hitting those good cap rates. I don't have a crystal ball, because if I did, I would buy all the properties.
Right. Yeah.
I'm sure you would too.
Absolutely.
Because then I know, like I'd have investors before, like, hey, I want to buy a house for $100,000 and rent it out for $2,000. I'm like, well, if I found that, I wouldn't be calling you. I would figure out how to buy it myself.
Yeah, exactly.
So, real quick before we wrap this up, what advice would you give buyers right now?
Yeah. So, do your research. Find a great loan officer that you feel comfortable with. Start there, right? Because it's no good going to a great real estate agent first, right? To make sure you're qualified.
Because all we're going to do is tell you to call them.
Right. And we're going to put you in underwriting before we send you to Christina, just to make sure. But look, Christina, we're meeting with people back, 3 or 4 months ago, where we would tee them up and pre-approve them, and then sticker shock kicks in and they see that rate and they're not ready to go right now. So it's meeting with somebody that's going to really sit down with you, go over your goals, and just devise a plan with a great real estate agent like Christina to meet those goals, and you will ultimately win.
All right. Well, thank you very much. And I thank you guys for tuning in. And as always, if you are looking to buy either in Summerlin, Henderson, Lake Las Vegas, Mount Charleston, and all those places in between, I'm looking to be your real estate expert of choice. So please, if you're looking to sell or buy, give me a call. And as always, if you like our videos, please hit like and subscribe and hit the bell so you can be notified of any of our videos. Talk to you guys next week.